When we talk about major investments, say an engineer planning a billion-dollar highway interchange, or maybe you deciding on a new business venture, the very first step is always estimating the cost.
Right.
We figure out that price tag for today, right now, at what we call time zero.
And that's actually where the danger is. A fixed cost estimate, that static snapshot, is really only half the picture.
What do you mean?
Well, what a project costs today versus what it costs and, what it generates over its entire life, say 10 or 20 years, those are just fundamentally different numbers.
Because money isn't static.
Money is not static. It doesn't just sit still in a vault. It moves, it flows, it generates interest.
Okay, let's unpack this because this deep dive is all about moving past that simple cost estimation to true financial evaluation. We're learning how to track that movement using a core concept in engineering economics, cash flow.
Often called the financial lifeblood of a project. And look, if you walk away with just one thing today, let it be this. Cash flow is the actual physical transfer of currency. It's the real dollars moving into or out of a firm, a project, or an account over a specific period. It is the reality check.
So this brings up a really crucial distinction, one that trips up even seasoned business people. Cash flow is not the same thing as profit.
Not at all.
But wait, if a company makes a profit, doesn't that automatically mean they have money in the bank?
Absolutely not. And that's a huge misconception. Profit is, it's just an accounting measure. It includes non-cash items.
Like what?
The classic example is depreciation. You write off the value of a piece of equipment on paper over time. That reduces your taxable income, sure, but no actual cash changed hands that year.
Oh, so it's a paper transaction.
It's a paper transaction.
Yeah.
Cash flow is the physical truth. It's the cash you can actually use to pay your vendors, to upgrade equipment, to hire staff. I mean, you can be profitable on paper, but completely bankrupt in reality if you can't visualize this movement of money.
Okay, so if cash flow is this physical movement, we need to map it. We need a model. And that starts with, well, simple bookkeeping, right? Every dollar has to be classified.
Precisely. Every single dollar has to be assigned a direction, either an entry, which is positive, or an exit, which is negative.
Let's start with the entries then, the positives.
Yeah.
Cash inflows. This is the money physically coming into the project or, into your pocket.
The most obvious one, of course, is revenue. Income from sales of goods or services. That's the engine.
But it's more than just sales, right?
Oh, much more. Engineers and financial analysts have to look beyond that. A great example is salvage value.
Okay, explain that.
Let's say you invest $50,000 in a piece of factory machinery. You plan to use it for 10 years.
Right.
At the end of year 10, the project's over, and you sell that old machine for $5,000 as scrap metal.
That $5,000 is an inflow.
It's an inflow. It's a benefit that happens at the very end of the project's life. If you ignore it, you've underestimated your project's total return.
And here's one that I think always catches people off guard when they first see it on a diagram. Loan principle.
When you borrow $100,000 from the bank today, that money physically enters your account. At that moment, at time zero, it is a massive positive cash flow for you, the borrower.
Even though you have to pay it back.
Yes, you have that liability, but the cash transfer today is an inflow. We have to track the physical reality, not just the eventual obligation.
And what about something more subtle, like savings?
Ah, that's a powerful one. If you replace an old inefficient boiler with a new one, and your energy bill drops by $10,000 a year.
That's money that didn't leave your pocket.
Exactly. It's not revenue you earned, but it's $10,000 that stayed in your corporate wallet. In engineering economics, we treat cost reduction savings as being equivalent to revenue. They both increase your net cash flow.
Okay, let's flip to the other side of the ledger. Cash outflows, the negatives, the disbursements, the costs, money moving away from you.
And these usually begin with the big one, the first cost, or the initial outlay. That massive one-time downward arrow at time zero to buy the asset or start construction.
Then you've got the day-to-day grind.
Right. Operating costs. O&M. That's your annual expenses for labor, materials, energy, maintenance. These happen year after year.
And we have to go back to that loan we mentioned.
We do. While getting the loan was an inflow, paying it back is an outflow. That's debt repayment, the payments you make that cover the loan principal plus all the interest.
Can't forget the government.
Never. Taxes are a mandatory outflow. If you neglect any of these outflow categories, Your whole project assessment is going to be wildly optimistic.
So for any given year, you just add it all up.
You aggregate it all. Take all the positives, the inflows, subtract all the negatives, the outflows, and you get the net cash flow, the NCF, for that specific period.
Simple subtraction. But knowing the NCF for just 1 year isn't enough, is it? How do you string all those years together to see the whole picture?
You can't, not just with numbers on a page. The moment you introduce the time value of money, the idea that $1 today is worth more than $1 next year, you need a map.
Which brings us to the most powerful tool in this field,
The cash flow diagram, the CFD.
the CFD.
It's your XY coordinate system for money, a simple, visual, graphical representation of all these cash flows over time. It forces you, the engineer, to stop thinking in the abstract and start mapping reality.
And to draw it, you have to answer 3 key questions for every single dollar.
You do. First, who is paying? This establishes your viewpoint, and the perspective is everything.
Second, when are they paying? This puts it on the timeline.
And third, what type of payment is it? Is it a huge initial cost, a future lump sum, a repetitive annual payment? Until you define those 3 coordinates, you can't draw the diagram correctly.
So let's break down the map itself. The horizontal axis is the bedrock, the timeline.
Right. This line represents the entire project's life, marked off in periods, 1, 2, 3, all the way to n. And crucially, time 0, t0, is always the present, right now.
And the money itself gets mapped with arrows, vertical vectors.
And their direction and lengths are everything. An upward arrow means a cash inflow money into the viewpoint's pocket. It's positive.
And a downward arrow is a cash outflow, money leaving negative.
And this is where the visualization really helps. The length of the arrow is drawn, roughly proportional to the dollar amount. So a massive initial outlay at time 0, that downward arrow should just dwarf the smaller annual operating cost arrows. You can see the financial stress points instantly.
Now, there's a technical rule here, a convention that makes all the math work. Because in the real world, expenses happen all the time, daily, even hourly.
And calculating interest on every single one of those would be unmanageable.
Wait a minute, isn't that a massive simplification, though? If you assume everything happens on December 31st, doesn't that throw off the interest calculation?
That is a great question. And mathematically, yes, it is an approximation. But the time-saving power far outweighs that tiny loss of precision. We call it the end-of-period convention.
The rule is,
Unless it's specified otherwise, all cash flows that happen during a period are assumed to happen at the end of that period.
so if my company gets a $10,000 revenue check in February of year 1 and pays a $500 maintenance bill in June, all of that gets marked at time equals 1 on the diagram.
Precisely. We collapse all that activity between T0 and T1 into a single net cash flow arrow at T1. Or we draw separate arrows for the major categories, but they all land exactly on that integer mark. This is the foundation for all the calculations that come next.
Okay, so we have our timeline, we have our arrows. Now we need a language, a notation, to talk about these arrows mathematically.
We use 3 primary letters to label the diagrams, P, F, and A.
Let's start with P, stands for present value.
That's a single lump sum amount right at time 0, usually that big initial cost arrow we talked about.
Then there's F, for future value.
Another single lump sum, but this one happens at a specific future time. And think of that salvage value we mentioned, that's an F.
And the most common one, A, for annuity. So P and F are single events, but A is different.
A is a series of equal consecutive cash flows happening at regular intervals. It's the repetition.
Like monthly rent.
Or an equal annual maintenance contract. If it's $5,000 every year for 20 years, that's an A. If the payments aren't equal every year, it is not an A. It's just a series of individual F values.
So those 3 letters, P, F, and A, along with N for the number of periods and I for the interest rate, that's really all we need.
That's the foundation. With those 5 variables, you can model almost any structured financial situation. But having the right notation is useless if you violate the golden rule of diagramming.
Which is?
The single biggest source of error in this entire field, the principle of viewpoint.
This is where it's really critical. The diagram is always drawn from a single defined perspective.
Always.
If you mix up whose pocket you're tracking, the whole thing is worthless.
Absolutely. We have to anchor it. Are we the borrower? The lender, the company, the homeowner. Inflow money into our pocket. Outflow money out of our pocket is an arrow down N. I once saw a huge infrastructure bid fail because the team mixed the bank's viewpoint with their own on the diagram.
Let's run through a quick example. Borrowing money. Say you borrow $10,000 today, and you agree to pay back $2,000 every year for 5 years.
Okay. From your viewpoint as the borrower, at T0 you get $10,000. That's a one-time cash entry. A $10,000 arrow UP, that's your P.
And then for the next 5 years, I'm making those $2,000 payments.
So that's 5 consecutive $2,000 arrows down. That's your A.
Okay, now let's flip it. Switch to the bank's viewpoint, the lender.
At T0, the bank gives you $10,000. That's cash leaving their pocket. So for them, it's a $10,000 arrow down it, a negative P.
And for the next 5 years, they're getting my payments.
Exactly. They receive your $2,000 repayments. For them, that's 5 consecutive $2,000 arrows UP, a positive A.
So it's the exact same transaction, but the entire diagram is just inverted.
Completely inverted just by changing the viewing window.
So the absolute key takeaway here is you have to explicitly label the diagram, CFD for the borrower or CFD for the bank, before you even draw the first arrow.
That is the whole lesson right there. Without anchoring the perspective, you can't even determine the direction of the flow. The CFD is a non-negotiable tool for visualizing financial reality.
So what does this all mean for us, for you, the listener? We've learned that time is basically the coordinate system of money. The cash flow diagram is the map that forces us to define who, when, and what type of payment is involved.
And without that map, you're just stuck staring at a static cost, totally incapable of calculating the true long-term value of anything.
And often the true cost is hidden by a very tempting initial view.
Let's bring this full circle. Let's look at that solar panel trap we mentioned. It's a classic real-world case where the CFD reveals the danger of ignoring the viewpoint and especially the annuity.
All right, the pitch is always so seductive. A solar company offers free installation, $0 down. You, the homeowner, just pay them a monthly fee for the power that's generated.
And that initial flawed viewpoint of the homeowner is focused only on time zero. They see no downward arrow, no big p-value. They think, this is amazing, no investment, it's free money.
But the reality, the correct CFD, tells a very different story.
A far more revealing one. Because that contract isn't for a few months. It requires monthly payments that form a long, very substantial annuity, a stream of A arrows stretching 20, maybe even 25 years into the future.
And those contracts often have an annual escalation clause, too.
They do. So when you actually visualize this, the homeowner's timeline is immediately just dominated by this continuous 20-year chain of down arrows, one for every single month.
And when you map out all those future costs and bring them back to their value today, which is what the CFD allows us to do, the conclusion is pretty stark.
It's inescapable. The sum of all those monthly A payments over 2 decades, when it's properly calculated, often substantially exceeds the cost of just buying the panels outright at time zero.
So the CFD instantly shows that the convenience of zero-down financing is paid for many times over by a massive long-term outflow that the homeowner completely failed to visualize at the start.
It's the difference between looking at a pretty flyer today and seeing the complete financial commitment over the entire life of the asset. The arrows don't lie.
That really is the power of the map. And I'd encourage you, the listener, to try this. Start visualizing your next big financial decision, a car loan, a mortgage, even a business proposal, by just sketching out a simple cash flow diagram. You'll be surprised what those long, repetitive arrows stretching out into the future reveal about the true cost of convenience.